Hello and welcome to the Rules of Investing, brought to you by Livewire Markets. I'm Airlie Selby, and today's guest is a favourite among our readers. She's been working in markets for 13 years, having started her career in equity research on the sell side in 2010 before joining Fidelity's Australian investment team as an analyst. In 2016, she joined Airlie Funds Management. It's the boutique started by investment greats David Cooper and John Sevior in 2012, and since then she's worked her way up to manage the Airlie Australian Share Fund alongside Hall of Famer Matt Williams. I'm talking, of course, of star stock picker Emma Fisher. In this episode, we'll be discussing why Emma believes it pays to be bullish over the long term in markets, how you can avoid the bears, the areas of opportunity she has identified today, as well as a few of her favourite stocks. Before we jump into the podcast, here's a quick word from our sponsor. Research shows that experienced investors are looking for an edge. As the first ever sponsor of Livewire's Rules of Investing podcast, Bell Direct is offering exclusive access to 3 current Bell Potter stock reports every week for a limited time and the chance to win a share of 3 million Velocity frequent flyer points, which we'll explain at the end of this podcast. Emma, thank you so much for joining us on the Rules of Investing. First off, I'd love to learn a little bit more about you. Without any fluff or jargon, how do you think about investing?
Oh, well, thank you for having me, Airlie, and you've just dropped me in the deep end with a really big question. So how do I think about investing? I think, well, first of all, I've got to define, what I want to be doing here, like what's my motive? And it obviously is long-term wealth creation. And then when you think about, well, why have I picked equities as an asset class rather than long-term wealth creation through property or bonds? I think, the thing that's always attracted me to stocks is this opportunity to invest in great businesses. I'm one of those people that my husband always says, I don't have any hobbies. I'm not good at anything, right, in the real world. And I think
I feel the same. Yeah. I'm like, what hobbies do I have?
I think it's a female and male thing, actually. I feel like most of my female friends don't have hobbies, but men, it's all, my husband's into cycling. It's always something like that, cycling or golf. But either way, I always think if I had to make it on my own with a business idea in the real world, I would be screwed. I wouldn't have a good cafe. I wouldn't have a successful hair salon. Anything I could do with my own money would be very unlikely to let me earn very good returns for a long time. And yet through this, amazing quirk of the system as a shareholder, I can sit as a talentless shareholder in my seat in our office and invest in these businesses that do have something really special going for them, that have great barriers to entry and, just effectively hitch my wagon to their long-term success. So I've always really loved that. And that's kind of attached to this concept of not trying really hard not to lose focus of, there's 2 worlds. There's the real world of business, and that's, when I was walking over here from my office, we're in Barangaroo, so it's quite a long walk, and I'm looking around, it's all these people going to work, going to their offices. That's the real world, people that are making things. And then there's financial markets, which aren't the real world. And I remember learning in uni, Finance 101, that financial markets, they exist to serve as the opportunity to raise capital for the real world. So having that distinction in my mind, it helps cut through the noise a lot, because a lot of the stuff that you read about, it really just pertains to financial markets. It doesn't actually change anything in the real world. So not losing sight of the fact that as an investor, you're investing in real businesses run by real people that are doing real things. And if you find the right business, the opportunity to own it for a long term and hitch your wagon to that business's success is really exciting for me.
Can we dive a little bit deeper into that? What are we reading in the financial world that is just, we need to, I guess, have a reality check?
Yeah, it's funny. So I, for whatever reason, our lunchroom, whenever I move away from my desk into the lunchroom, they've got CNBC playing all the time. So I kind of been exposed to, I would classify that as the financial media. It's playing 24/7, and obviously they've got to fill their slots. But a lot of the stuff that I hear kind of does make me laugh. I remember the other day, some guy was talking about the Fed decision, but his wording was American guy, do a terrible accent, the whole financial world is waiting to see tonight if it's a hawkish pause or a dovish pause. And I just, everything hinges on that. And I just laughed. I'm like, what hinges on this? This is, Matt, who I work with, always says, this is tomorrow's fish and chip wrapper. It's a different, the media, I suppose, it's a different business model. You've got different motives. You're trying to sell something. You're trying to attract eyeballs, whereas we're trying to make money over the long term. So I'm pretty passionate about this when it comes to like individual investors and personal investors who are sitting at home and consuming all of this stuff. I don't want them to, let some of these voices, I guess, bluff them out of accessing the really powerful long-term compounding that investing allows you to have. So I always try to, have that mindset of, trying to cut through this noise. But yeah, maybe not everyone has that. And the fear, and there is a lot of fear, fear sells. It's a really strong human psychological element, right? We especially when it comes to money, like we're so fearful of it. That study, like people would rather not lose money than win money. So it's a really powerful kind of behavioral force that markets and media have hooked into. And you have to kind of have your wits about you to push back against that, which is why, for me, I keep coming back to this, does it matter in the real world? Like this guy saying that all that matters for markets is the tone of the Fed that month. What really matters is it doesn't tell you anything about for Westies. So like, is anyone ever going to really close that gap between Bunnings and their nearest competitor? That's what really matters, having a view on that. For a business like CSL, what's the probability of success of CSL 112, which is their biggest, drug in their pipeline, which is a potential cardiovascular blockbuster? That matters for that business. All the stuff that you read about day to day, very little of it matters in the long term for investing.
Okay. As a retail investor, I find investing quite stressful at times with all that negative news and fear that you see. I imagine professional investing is even more stressful. I mean, you're constantly being compared month to month on your performance, let alone to your peers. What keeps you inspired?
Yeah, it's a good question. Like, I've thought about this a lot. Whenever I go to think of my job as stressful, which I do sometimes, I remember like quite a formative experience when I first started in the industry. I was working in equity research on the sell side, so at a broker. And, you work really late nights. It can be quite a stressful environment. And I remember somebody once saying, this job can be so stressful sometimes. And one of the guys that I worked with, he's awesome, really smart guy. He used to be an orthopedic surgeon. And he like cut this guy off and he's like, this isn't stressful. He's like, operating for 12 hours trying to save someone's life is stressful. Going out and telling like a mother that you couldn't save their kid, that's stressful. This isn't stressful. And it was actually really, like, it always stood with me as like this really valuable reference point for the fact that, we aren't, the pressure comes from the fact that you're investing other people's money. That is a real pressure. That is a real responsibility. That's something that I don't take lightly. And I think it's good to feel that pressure every day because it stops you from, making willy-nilly risky calls. But beyond that, I don't think leaning into or dwelling on the additional pressure is in any way helpful for helping you make good decisions. So it's a long way of saying, like, I try to keep it light. Like, I lean into the fun in my job, and it's an amazing job. And I think I like the way that you phrase that question of what inspires you, because what inspires me is, being able to be part of this world of constant learning. You get to learn a little bit about so many different industries. And like, it's kind of like this airplane test of often I'll be sitting in an airplane seat and chatting to the person next to me. And when I ask them what they do, so often, no matter what industry they work in, I have a very, very small sometimes, or sometimes quite large understanding of the basics of that industry because of the job that I'm privileged to do. And then the other thing that really gets me inspired is like, you get to be around really smart people. I think sometimes you can lose sight of the fact, like, as a professional investor, you get an hour of management's time maybe twice a year, and you can lose sight of the fact that these people have worked their way up through a really large organisation in a lot of cases. They are the cream of the crop. And that's not to, blow smoke up every management team, but I think you have to have a healthy level of respect for that. And it's just such a cool dynamic that, I'm like a nobody in my 30s, and that I get to spend an hour of their time understanding how they think about business, understanding how they think about strategy. That's also really cool. So that's what inspires me, being part of the world of constant learning and understanding how the world works.
You're definitely not a nobody in your 30s. I feel very privileged to sit down with you today. And it's one of my favourite things about this job too, is that you get get to sit and learn from the smartest people in the room. It's been 2 years since you last appeared on the Rules of Investing podcast. Rates have lifted 400 basis points and the ASX 200 really hasn't gone anywhere since then. In your mind, what has been the biggest change in your portfolio over the last 2 years?
It's interesting when you reflect on it like that, because if I'm honest with myself, and I'm lucky 2 years ago that I can't actually remember, but I don't think anybody did ask me this question because I would have got it really wrong. But if I'd been standing 2 years ago and if I'd known in advance that rates were going to rise 400 basis points, which is very quick in 2 years, well, for starters, I actually would have been arguing that wasn't going to happen. I put myself in the camp of, you hear when rates were on the floor for so long, every now and then you'd hear somebody typically an older boomer say oh, what are you going to do affording that mortgage when rates are back at 5%? And I remember always thinking in my head, they're not going back to 5%. And the reason that I thought that, I thought it was valid reasoning at the time was, rates are effectively like a brake and an accelerator. And as rates came down, the level of debt went up in response to that. And so I thought we'd be more sensitive to the brake. I thought you'd only need, throwing a number out there, maybe 200 basis points of rate rises to affect the slowdown that those rate rises were trying to affect. And I was just totally wrong on that. Now, luckily, because I'm not a macro investor, it's not as though I've positioned a portfolio for this view that, being wrong on it has meant that we've dramatically underperformed or anything. It's just a reflection. I put myself in one camp and I've learned 2 years later that I was totally wrong. The other thing that I've learned, which has amazed me, is if you'd asked me 2 years ago how many companies in the ASX had pricing power, I think I would have been able to name 3 or 4 straight off the top of my head, and they would have been the really obvious high-quality businesses. But it's turned out that almost everyone has had pricing power. And I suppose that's what inflation is. It's passing on cost pressures through price increases to an end consumer that has been extraordinarily willing to wear it. But that has surprised me. So it's interesting, to look back 2 years ago and think about how much I've learned in such an extraordinary period, how it's flowed through to our positioning. Again, because we're not macro investors, there hasn't been a huge amount of change, say, in our top 10. What would be different is sometimes we'll own a business that's really more of a trade rather than a long-term holding. A lot of businesses will typically want to own, ideally forever, unless something gets really crazy in terms of the valuation or the strategy. Something like a Wessy's, Bunnings, such a good business, we're probably there for a very long time. Whereas, 2 years ago, we might have owned, in our top 10, you'd probably see a stock like Helios, which we no longer own. And it was really a trade, and we actually sold that when they bought that at Gillick's business because we thought that we couldn't make sense of the price they paid, and we'd lost confidence in the capital allocation decisions. So that's I guess that's an example of one that we owned at the time. But it's always going to be stock specific reasons. It's never we sold this stuff because we started getting really bearish on this particular cycle.
Is there any portfolio holding that you feel like has been more resilient than you expected over that 2 year period?
Well, that's a really good question. I would say James Hardie, and I know the reason is ultimately that they have. And funnily enough, if you'd asked me 2 years ago to name those companies with pricing power, that would have been one of the three. So they've exercised that pricing power. They've pushed through a lot of price over the last 3 years. But the dynamic has been that for the first 18 months of that price increase, they needed it because their raw materials just went crazy. So they had a lot of margin pressure. So you didn't actually see it really hitting, benefiting the earnings. And now the opposite is happening. A lot of their costs are coming off. They've taken so much price, and so their margins are being very, very resilient. Now, the reason I say that's surprising is because obviously James Hardie is a building product. They sell it mostly into the US housing cycle. And again, if you told me that 30-year mortgages in the US were going to go from having a 2 handle to, for 1 month having an 8 handle, I would have thought that would have been totally smoked. All activity would have been smoked. But it's been remarkably resilient.
There's a great saying in markets that being bearish sounds smart, but being bullish makes money. In your latest annual review, you drew on some long-term data to demonstrate why it pays to turn down the noise, particularly in times like these when consumer confidence is at 1991 recession-type levels. In the report, you note that in the last 35 years, we've seen 7 years where the total return of the ASX 200 was negative and 28 where it was positive. In my industry in news, there's a saying that bad news sells. Can the same be said for markets? Why do we pay attention to the bears so much?
Yeah, it's a good question. I think, and I do this too when I read something that's quite bearish. Like, it plays into our psychology. It plays into our wiring of fear being a very emotive feeling. And so you sound smart when you're bearish. You sound like you have considered some risk that other people haven't considered. So I guess what I wanted to do in that analysis that you're referring to, so I had a look back at the returns of the market and broke them down. I kind of wanted to just create some I don't know, intellectual weight behind this constant feeling like I'm a dumb bull versus these smart bears. And, you know, the data bears it out, I suppose. 4 years out of 5 over the last 35 years, the market has risen. It's really only the 1 year in 5 that, you know, you stub your toe. So I guess I'm happy to, if I'm probably not going to predict which 1 year out of 5 I'm going to stub my toe, I'm just happy, you know, as long as I haven't got a lot of risk on the table to sort of wear that, to participate in the 4 years where I'm having a good time. But what was interesting about the analysis was that earnings actually fall a lot more frequently than the market. So there have been 7 instances where the market's fallen in the last 35 years and posted a negative return. But there have been double that, 14 times that earnings have fallen. So earnings are falling 2 out of 5 years, which just goes to show that, you know, you can't just focus on one thing. It's a big pie. And the reason that earnings are more volatile than the market is because you're also getting dividends. And the market's pretty smart. When earnings fall out of bed, it usually re-rates those earnings and puts them on a higher multiple, and that can offset some of the damage. You know, in the GFC, for example, earnings fell 40%. But because the market re-rated, the market only fell 20. Now, only fell 20. That's a pretty bad time, but it's not 40. Because the market says, well, hang on a second, this is clearly below mid-cycle activity, so we're going to put it on a higher multiple. So that's kind of a natural offsetting factor.
Also, I mean, when there is this much fear, that's usually the best time to invest,
Absolutely.
right?
Like on a stock-specific level, I think a really good example last year would have been Medibank. You know, I always say to myself, if it's in the papers, if it's in the headlines, it's probably in the price. You know, Medibank's cyber attack was very emotive. It dominated headlines for, I can't even remember, maybe 4 to 6 weeks even, and it smashed the share price from $3.50 down to, I think it got to $2.80. For, you know, a big, steady, large cap stock, that's a huge amount of value destruction. I think it was something like $2 billion of market cap wiped off because of this event. You know, we did some calls. I can't say, you know, we got to the bottom in terms of cybersecurity experts about the issue, but what was more instructive was I basically asked everyone I knew, because they've got 30% market share. So anyone you talk to, 1 in 3 of them are actually with Medibank.
Yep.
I asked everyone I knew, mates, things like that, sent out a bulk text, like, are you with Medibank? And is this cyber attack meaning that you're going to switch? And actually quite a lot of people came back and said, yeah, it's my health data, so I am quite sensitive to it, so I think I'm going to switch. But not one person said they had. And then I thought, oh, I know my mates, they're pretty lazy. Like, inertia is a very, very powerful force. So nobody had switched, and this was, you know, well into the saga. So I figured once it's off the front page, the impetus is gone. You just forget about it. So we bought quite a lot, and it ended up being the right call because it ended up being quite a short-term factor. And this just happens all the time. So many things just seem to dominate the story. And if you're looking, you know, some things genuinely do change the long-term value of a company. There's no doubt about that. But not as many things as you'd think. And certainly not as many things as do happen. So exploiting that tension between something that seems to matter in the short term but something that actually truly matters in the long term, and something only really matters in the long term for a business if it changes the returns profile of the business. So I always kind of refer to this analysis because it astounded me, but like if you go back to 2019, we had a look at the ASX top 20 and what the 52-week changes between high and low was in that year. And we picked that year, and I still refer to it because, like, I think it was like the last boring year that we all lived through. Like, I can't think of one historical event that happened in 2019. And yet the 52-week high and low for like the top 20 most boring stocks in Australia was 45%. And then, you know, if you look at the 100, the ASX 100, that number was something like 60%. So their values are changing so quickly, but their real value in the real world is changing over years and decades, really, really slowly. So I'm always interested in exploiting that tension, I suppose, between, the short-term fanaticism of the share market and how few things actually really change things for businesses in the long term.
I feel like there's two instances of stocks where we're seeing a lot in negative news right now, and that being Qantas, of course, and ResMed.
Yep.
Do you see any opportunity there?
Yeah, it's funny. Qantas, you're totally right. And part of me definitely just wants to go out and buy it because I'd say, it's got everything going against it right now. The X factor for that stock and the thing that holds me back is the fact that they have an incredibly large CapEx program ahead of them. So they need to fund, I think, something like $15 billion worth of fleet renewal over the next...
Thank God, their planes are terrible. I was recently on one. They are really bad.
They are really bad. If I come on board as a new shareholder, I'm funding that. So it's funny, you look at the enterprise value of the business today, if you know that they have to replace pretty much their whole fleet, then you're not getting the fleet as part of that enterprise value. What are you getting? You're getting a brand, you're getting an idea, and that's an idea that's really tarnished. So do I want to come on board and fund that fleet renewal so that at the end of that period, I suddenly own a business that has assets, hard assets, and a brand? I'm not sure. I don't think it's obvious. Now, what could make it obvious would be another big leg down in the share price. That would be an instance where suddenly the valuation accounts for all of the risks. But, I try to be pretty dispassionate about this stuff. You value it, you model how you think the cash flows are going to land. You probably want to detract some regulatory fines, probably want to detract some reinvestment into the business. And you're starting to see them already admit that they have to do that. And you're left with some level of operating cash flow that probably, off the top of my head, will be somewhere around $2.5 billion of operating cash flow. But they're pretty much going to have to spend all of that on planes each year. So what are you left over as a shareholder? Not much. So it's a tough one because I don't want to be too negative on it at the same time because I love these instances where it's a total pile-on. Equally, in 100 years, I think Qantas is going to be around. I think they're going to be making a ton of money. I think they're going to be our dominant national carrier. I think their position, I've met with other airlines across the world and none of them have anything like the golden goose that Qantas has. If you meet with, airlines in the UK, it is just so competitive. You make no money. You don't make no money on short haul. You just hope that you make it up on long haul. It's the opposite for Qantas because we have such a large country, that golden triangle of people flying to, effectively up and down the East Coast. That is just so lucrative for them. So, it's something we've done a lot of work on. We keep looking at the situation, but right now we don't own it. ResMed, though, I'm glad you asked about that. ResMed, I think, I don't want to be too unequivocal. No, I'll be unequivocal. I think it is probably the most interesting or outstanding buy idea on the ASX right now. It is probably one of the top 3 highest quality businesses of the last 20 years listed on the ASX. It's been a 17 bagger since 2004. So very high quality company. And right now it's trading on a PE of 19 times. And to put that into context, if you take the market and you strip out banks and you strip out miners, what you're left with is what we call industrial businesses, which is just another way of saying it's not a bank and it's not a miner. Industrial businesses are trading on an average PE of 20.6 times. So this is a business that's got one of the best track records in the ASX, and it's cheaper than the bog average industrial business. It's cheaper right now than Telstra, So not to pick on Telstra, but I know which business has a better track record of creating value. So why is it cheap? Well, very, very quickly, in the last 6 weeks, basically, global investors have decided that GLP-1s, which probably are more better known by the brand name Ozempic, although there are other brands, but let's call them Ozempic. These weight loss drugs are going to cure obesity. And sleep apnea, which is the devices and masks that ResMed sells to treat sleep apnea, about 70% of people with sleep apnea are obese. So it's gone from being this company where everyone's seen, basically 6 to 8% top line growth ad infinitum because nothing is holding back obesity growth rates, sadly. Death, taxes, and, people getting fatter. That they were the sure things in life. And then suddenly we've got something that looks like it could be a solution. I'm happy to take the other side of that bet for a few reasons. mostly for valuation reasons. I think now the share price is pricing in very extreme degradation of its end market. Basically, a third of their, let's say, install base for sleep apnea patients, a third of them, it's not obesity related at all. So, they're a lock no matter what happens with the penetration rates of Ozempic related drugs. A third of them have severely obese, so have such high BMIs. Now, these drugs are associated with 20, maybe some of the early stage, later, the next drugs in the pipeline even higher, but 20 even 25% body weight loss, huge. But that's not enough to bring a severely obese person down to the level of what's called AHI, which is so it's an index to see how bad your sleep apnea is. But basically, it's how many times in an hour do you stop breathing during the night. Now, the fatter you are, the more weight there is on your neck, and so that number tends to be higher. So very, very obese people with very high BMIs will have 60 times an hour where their airway's collapsing. If they lose 20 or 25% of their body weight, that is fantastic for them. They will be able to have a CPAP device and a mask and use a lot less pressure to keep their airway open, but they won't be able to come off CPAP, I don't believe. Their BMI will still be too large. They'll still be technically they'll have sleep apnea still. So my view is a third not obesity related, they're fine. A third too obese to lose enough weight to come off it as a reasonable base case. So they're probably fine. And then it's about the 1/3 that are overweight but not obese. And what happens to those people? Do they lose enough weight to come off the drugs? Now that's going to be around adherence and their ability to access the drugs. So these are very expensive drugs and they have a lot of side effects. And if you come off them, you put the weight back on. So you have to be on them for life. I've been trawling the Reddit group of people that are on Ozempic and a lot of these drugs. And, every second or third post is people complaining about nausea and, going to the bathroom accidentally and stuff like that. It's not the sort of stuff ideally you want to be on for life. So for all those reasons, I think it's overblown. The share price has fallen about 35% in the last couple of months and now is trading at a very attractive valuation for a great business.
I want to turn now to the subject of investor psychology. In your view, what separates the good investors from the exceptional ones?
Yeah, I think it's all around temperament. So I've noticed, I don't put myself in the camp of exceptional investors, but I really concentrate on people, what people who I do consider exceptional investors, what they do well. So I guess I'm speaking of my observations from people I really respect and admire, what they do differently. And I think it comes down to temperament. They're often pretty relaxed people. So any portfolio manager is, you're only as good as your analyst team because you cannot be all over everything and you cannot be all over the detail of everything. So you need a really good team of people that you know and trust that are, feeding you good ideas. And a good portfolio manager allows people that work with them the space to make mistakes and allows themselves the space to make mistakes. I think it can almost be distilled to you've got to be willing to be wrong. Doesn't mean you want to be wrong, but you've got to be willing to be wrong. Your ego has to be able to handle it. That's why I think ego is so dangerous in investing because you probably start pushing back I wasn't wrong, this happened, who could have foreseen that sort of stuff. You have, we're going to be wrong as investors very, very frequently. It's only valuable if you can look at your mistakes and go, well, here's why I was wrong and here's how I can avoid that next time. But I've noticed that in interacting with basically the higher the hubris, the less willingness you are to admit that you're wrong. And that is just fatal for an investor. So they're usually people that are very grounded, have great temperaments, are relaxed, allow the people around them the space to be wrong. They themselves have the courage to be wrong, to get off the fence. Because that's what it's not correlated with intelligence. The smartest people I know don't make the best investors. It's almost negatively correlated, I think. If you're too smart, you can see all the risks and you'll never get off the fence. And that's the thing with investing is you never know, you'll never get full comfort that your answer is correct, that to buy something is the right answer. There's always, especially because when the value's there, the risks look like they're there. So you have to be willing to take on risk and lean into fear. And I think this almost the more intelligent you are, the more risk you see and you can really suck yourself out of taking a view. So yeah, it's not necessarily intelligence. It's this weird hybrid combination of a very even temperament and a willingness to be wrong and a lot of courage.
Do Do you feel like during your 13 years in markets, you've noticed any biases or weaknesses within yourself that you've learnt to, I guess, tame?
Yeah, absolutely. And this is why I love my job, because you just get hopefully better every year. And I think when I was younger, definitely my worst bias was losing conviction at the bottom. I would just feel like an idiot and just really be lost in the mistake that I'd made rather than leaning into the fear. Because, take ResMed, for example. We first bought that probably around $30, $31. Not a very big position. It's fallen like a stone. It got to $21 the other day, and we have dramatically increased our position. So should I have just sat there and, flagellated myself for buying it at the wrong price and not had the courage to add to that position? That would have been, hopefully, still live, so I haven't been proven right. But I think that would be the wrong way to play it. But that's probably what, the old scared me might have done. I can give you countless examples in the past of times, stocks like James Hardie where there is a cycle at play where, the opportunity is there and you have a small position, but you don't back up the truck in the way that you should have for something that you know really well. And you don't back up the truck because you're fearful at the same time that everyone else is fearful. So I try to push back on that. It's really helpful. Matt Williams, who I work with, who's, he's a Hall of Fame investor. He's been doing it for 30 years. I'd say his best quality is his courage. He's the opposite of that. When things fall, he just wants to buy. And that has been a fantastic counterweight for me. So if I give myself a scorecard, I've noticed I've gotten better at that, at leaning into the fear. But part of it is just being able to acknowledge that is your weakness, and if you're aware of that, it's what I call point of maximum pain. Like often when I'm feeling the worst about something, like when I'm feeling like I never want to see that ticker again, like please don't bring up this company, that's usually the point of maximum pain, and that's usually when the stock is a buy. The only rule that we have where that isn't the case is when the balance sheet is bad. And if there's any reflexivity between earnings falling and suddenly the balance sheet gets called into question, you don't want to go there. That's actually when you probably should cut your losses and sell. But if the balance sheet's good, the lower the share price, the lower the risk. That's all there is to it. So you should usually be holding at the very least or adding.
Let's dive deeper into your portfolio. With consumer confidence at recession levels, where are you seeing the most value today?
Yeah, it's interesting, the consumer confidence thing. So we went and had a look back at this. So I would have had a really good answer for you 3 months ago, a really clear answer. I would have said there are some retailers that are absolute screamers. I won't say unfortunately because we did own some of them, but they've had a pretty big bounce, and I don't think they're screamers anymore. But we did some analysis a couple of months ago. So retail was totally on the nose. It was a downgrade a week from retailers. Everyone was saying this was in June or July. You had dust come out and footwear companies and Baby Bunting, and just everyone was downgrading, and the sector got smoked. We own Nick Scali, we own Premier Investments. Premier Investments, for example, went from $24 down to $18 really, really quickly. So we were adding like crazy, and it's now back at 25. But what gave us the confidence to add, I suppose, was we did some analysis on the consumer confidence front. For example, if you had a decision rule to just buy every time consumer confidence bottomed, how did the Australian discretionary retail index as a whole go over the next 6 to 12 months? 9 times out of 10, it was up dramatically. So it's actually kind of like a reverse signal. When consumer confidence is low, it's almost like it can only get better, and it's a good time to buy the stocks because the stocks are usually cheap. We looked at it specifically for Premier and for Nick Scali. Again, both of them, if you had a decision rule to just buy every time they got really cheap, and that at that time they were very, very cheap. We looked back at that over 10, 15 years. The stocks were up, in some instances, 50 to 100% in the next 6 to 12 months. So, it kind of backed us up that you want to buy these things when, well, first of all, when they've got great balance sheets. So Premier, for example, it's got 400 mil net cash. It owns 25% of Myer, 25% of Breville. So, listed equities puts it at over $1 billion kind of fortress-like balance sheet. So, no matter what happens in the cycle, it's going nowhere. It's a very well-capitalized company. And then it's got cracking businesses like Peter Alexander and Smiggle that when people go from hating retail to loving retail again, those are the businesses that are going to fly because they've got unique propositions and great returns. So, yeah, that was kind of our framework. And I think it's probably a lesson of, there's this short-term focus on trying to avoid or figure out where you are in the cycle and cut your exposure to things that are, negatively impacted by that point in the cycle. again, it brings it back to that. If it's in the headlines, it's probably in the price. And I've made this mistake before in my career. I remember when I first launched the Airlie Australian Retail Fund just over 5 years ago, our largest position was Reece, because Matt's loved Reece and invested in it for decades. And I think day one, it was $12. If you go back to 2018, if you remember, like, Aussie housing was totally on the nose. Shorten was looking like a certain to get in. He was going to remove negative gearing, and basically anything related to housing was absolutely smoked. So the stock went from $12 to $9. And of course, I get point of maximum pain fear at $9 and cut the position. And 3 years later, it's $27. So I didn't cut it to nothing, but I reduced the risk that I saw at the time. Totally wrong decision. Totally wrong decision. So now I have this mindset of, where is fear around the short-term cycle giving us an opportunity to buy a great business at a reasonable price? Because it's so rare that you can buy a great business at a reasonable price. Usually if it's obvious that a company is a great business, they're on, crazy multiples. So it's because there's a cycle a lot of the time that you can buy them on cheap multiples. So Hardie's, a year ago, the US housing market, the outlook was so dire. The stock derated from mid-20s, which is usually where it sits, down to like 13 times earnings. And again, the average company's on 20 times. So 13 times is incredibly cheap. And this is a business with a much better track record than the average company. So you could buy it cheap then, and now it's nearly doubled. The retailers, just having this mindset of everyone's selling the retailers right now. So how about I go into that sector and find the best ones and buy them, and I won't get the bottom, and I'll probably look like an idiot for 3 months or 6 months, but it gives me a chance to buy these great businesses at a good price, which is so rare in markets.
If consumer discretionary has rebounded recently, where are you seeing maximum fear today? Would it be like the REITs? Or
that's exactly what I was going to say. Yeah, definitely the REITs, definitely. And we own a couple of REITs. Nothing, no major swings, but the largest position we have is in Charter Hall. And I think what attracts us there is, because it's a fund manager, it's got the economics of a fund manager, and it also has, Airlie's a fund manager, and any fund manager would know that you've got great economics. Like, you don't need capital to grow your business, but there's a fragility there because the fund can disappear tomorrow. Whereas Charter Hall, they've got a lot of factors that makes their fund very sticky. You've got 7-year redemption windows in a lot of their funds. If they have some of their funds are a partnership with large insto clients, and those partnerships are sort of evergreen. Like they can never get out. If they want to get out, they find another partner to buy in, basically. So it's sort of very, very sticky money. And, do I know what the 10 years is going to do? Absolutely not. I don't spend my time trying to figure that out. What we're reacting to is what the valuations are implying. And I think that's one where the valuations are implying, pretty bearish outcome.
Okay, you've pitched quite a few winning stock picks in your career, including CSL, Wesfarmers, PWR Holdings and Mineral Resources, to name a few. I want to talk about CSL in particular. Obviously, there's been some concerns recently on their outlook and the Vifor acquisition. Has that changed your view on that stock?
Yeah, it's a good question. I mean, the short answer is no, but the longer answer is, one of the most difficult things in investing, I think, is trying to figure out what to do when in real time you have a downgrade in your own view of a company at the same time as the share price has moved down. So that's kind of the situation that I'm in with CSL. And really, the downgrade in my own view of the company, slight downgrade, is related to the Vifor acquisition. They paid a very big price for that. I'm not entirely sold on the rationale. I struggle to see who's really, from a management perspective, owning the decision. The prior CEO has now left. And then, there's just some things that, like, when I've covered CSL for a very long time, and it's just not the CSL of old. Some of the things like, buying this business and then immediately restating all of the segments so that we now can't really get an apples and apples look back at how the divisions are performing. And then, they did the final allocation of goodwill on the acquisition. There was a lot of goodwill because they paid a very big price, but they allocated the bulk of it to the CSL bearing business, which is their base business. Now, they have their reasons for that, which is that, they think that a lot of the benefits from owning Vifor will accrue to that division. But the skeptic in me says, well, if they ever need to write down the goodwill or do an impairment, they're now not going to have to because they're testing it against bearing, which, is never going to lead to an impairment. So it's just little things like that if the CSL of old wouldn't have done them. But then I weigh that against a share price that has fallen, so a valuation that is more compelling now than it has been in years, and B, the fact that Vifor is not a huge part of their business. It's about 12% of EBIT. And the bigger part of their business, which is CSL Behring, their plasma business, which is about just under 70% of their earnings, I think it has a really good outlook. It was smashed during the pandemic because it was very hard to get people in the US, which is where their collection base is, to come and donate plasma. They get paid to donate, but basically because of the pandemic, no one wanted to come out and donate plasma. So they had falling volumes. At the same time, they had to pay people more and more to come. So it was sort of like a double whammy that really torched their gross margins. Like pre-pandemic, they made a 58% gross margin in Behring, and at its lows last year, they made a 49% gross margin. So we're talking, 900 basis points of gross margin erosion. So we think that then goes the other way over the next few years, and that underpins a lot of earnings growth. So we like it, we own it, but I'm just being honest about, it's not, my job isn't to be a cheerleader for every company we own. My job is to, allocate capital to where the kind of trade-off and weights between business quality and valuation and balance sheet and management, where that all looks attractive. And I think the answer for this stock is that it looks attractive, but there are things that, I'm watching that kind of annoy me.
Right, so you wouldn't be buying more today?
No, I would be actually. I would be at current share price, yeah, I would be. In fact, but like I said, there's just little things that irk me. I'm not a big fan of big acquisitions. Now, CSL have one of the best track records of transformative M&A, so they've earned the right. And that's why this deal, which was the largest raising in the ASX history, I'm pretty sure, that's why it was supported. That's why it got away, because the two acquisitions they've done in the past, which was the original Behring business, the plasma business that set them up for what they've delivered, and the flu business. They bought a loss-making flu business for $200 million, and they had to immediately write it up to their balance sheet because the raw assets that they bought were worth more than $200 million. And now that business has gone from loss-making to making $300 million. So everyone's primed to think CSL M&A is a good time, and this may end up being a belter, but my hackles are up, my antennas up. I think everyone's is. They have to deliver, put it another way. This won't be flu because they didn't get this business for a song. It's going to sit on the returns of the business for a long time. This was an incredible organic growth company with very high returns, and they paid a big price for an asset that people are kind of wondering why they bought. So they need to deliver. That's all there is to it.
We've come to the end of the podcast where we pose 3 common questions to our guests before we wrap up. It's a bit of fun. It's a bit of a thought experiment. In your view, what is the one thing investors are getting wrong about today's market?
Oh, that's a good question. I mean, I guess I've alluded to it in the course of this conversation, but just this dominant focus on the macro. Like, I get why it's really interesting stuff, trying to think about where interest rates are going or where inflation's going and all these macro things. So it's not that it's not interesting, it's just that I don't think anyone's going to get it right. And even if you get one thing right, you're probably not going to establish a good track record of getting every macro call right. It's just too hard. The world is too complex. There's just far too many variables. I think, look at the Fed. Like, you look where the Fed dot point plot was 2 years ago. They thought rates were going to be like 1% now. So the Fed don't know. So, and then markets sell off because the dot point plot has changed. The Fed don't know. They are reacting in real time along with the rest of us. Yeah. So don't put any value in what they're projecting because they do not know. So this short-term focus on the macro, I don't think it's a good use of my energy.
Okay. Can you share a story of a big win or a big loss from your investing career? What happened and what was the lesson that you learnt from that?
Yeah, I'll share a loss because I think you learn a lot from your losses. And I think you learn the most from like your early losses because everyone's got it. Every investor's got a stock that they never want anyone else to bring up because they feel like such an idiot whenever it comes up. So I will reveal what my stock is. So Slater and Gordon, like, this is the ultimate blow up. Like, when you think about risk in investing, the ultimate risk is that you don't get your money back at all because the stock's a donut. So this is as big a mistake as you can get. I was a young analyst. This would have been 2015. So, I was nearly a decade ago, and I thought it was a buy and it wasn't. And the lessons that I learned have been, you can learn lessons, but some lessons are like etched in your veins. And these, when you go through such a blow up, a big position that goes to zero, like they're etched in your veins. So the lessons were really powerful lessons, really grateful that I learned them so early on in my career. But, what went wrong was effectively this was a people business and they bought a UK business that didn't make any money and they debt funded that acquisition, and it was a large acquisition. So it taught me, I said earlier I'm so skeptical of acquisitions. It taught me to be wary of acquisitions. It taught me to be very wary when they're debt funded. It taught me to be very, very wary when they're debt funded and they don't generate a lot of cash flow. And it taught me, as a result, roll-ups as well. This was a lawyer roll-up. They were buying law firms and bringing them into the fold. They also had quite a lot of latitude on how they recognise revenue. So it was all around work in progress, and they could book it as revenue, but it wasn't booked as cash.
Yeah.
So again, like as a young analyst, I was sucked into the narrative that management were feeding us around why you had this dispersion between cash and revenue. But the cash flow statement never lies. Like the P&L can lie. The cash flow statement doesn't lie. So that, laser focus on the cash flow statement. And that just tells you so much about you. You really need to understand as an investor, how does cash flow through a company and what are the cash needs of that business? And when you throw in debt, low cash flow generation, a potentially fraudulent acquisition that they bought, and a lot of debt is a toxic combo. So I'm very, very grateful to have made such a cataclysmically stupid mistake very early on in my career, because I learned a lot of really powerful lessons.
Would that be the most important factor investors should look at then, cash flow?
Yeah, I think so. I think I always struggle to distill it to one important factor, but I think I would be paying more attention to long-term cash flow generation out of a business than long-term EBITDA, for example. And EBITDA would get a lot more of the focus.
Definitely. More of the headlines as well. Okay, last question for today. If markets closed tomorrow for 5 years and you could only own shares in one company, what would that company be and why?
I think I need to, given what I said earlier, I think it's got to be ResMed. At least, thinking it through, I think in 5 years' time, if I'm wrong and the people that, think GLP-1s are going to decimate sleep apnea market are right, I don't think you're going to lose much money, because I think that's what the share price is implying. And if they're wrong and I was right, 5 years is long enough to kind of prove that out, that it isn't having a significant impact on their end markets, and I think you'll make a lot of money.
Okay, well, thank you so much for your time today, Emma. I've absolutely adored this chat. Thank you again.
Thank you so much for having me.
I hope you enjoyed that episode as much as I did. Thanks again to Bell Direct for supporting this podcast. And remember, for a limited time, you can get 3 Bell Potter stock reports each week, and you'll go into the draw to win a share of 3 million Velocity Frequent Flyer points. So go to Bell Direct, check the full terms and conditions, and look for the Livewire logo to get your Bell Potter stock reports now. Competition ends 31 October 2023. Entry conditions and eligibility criteria apply. New South Wales Authority number TP/02866, SA permit number T23/123, ACT permit number TP23/01592.